This video segment completes our discussion on the economics of global climate change, focusing on the discount rate, intergenerational equity, distributional issues, and economic models. The major points of this segment are: number one, the discount rate largely determines the economic feasibility of projects to mitigate climate change. Number two, intergenerational equity means that institutions should sustain their assets at similar levels for present and future beneficiaries. Number three, economic models indicate that governmental economic policies to address global climate change are not only feasible, but desirable. A key parameter in any accounting of climate change economics is the discount rate. Banks lend money at interest rates that incorporate the risk of non-payment, the rate of inflation, and a decent rate of return. Government borrowing, however, carries a low risk of non-payment, and cost-benefit analyses of government projects ignore inflation because they calculate everything in terms of constant currency, such as 2012 US dollars. To convert values of future costs or benefits to present ones, governments use a different rate, most commonly called the discount rate, which depends primarily on the rate of return on investment. What constitutes a decent rate of return on investment and thus an appropriate discount rate? Several processes come into play. First, there is the impatience principle, whereby people expect some compensation if they must wait for something. Say, for example, you order a hybrid vehicle today, but the car dealer tells you that it is back-ordered and that they can only deliver it 3 months from now. You might cancel the order or request a discount. The size of the discount that you're willing to accept for waiting 3 months equals the annual discount rate compounded continuously over a year. Second, there is the marginal productivity of capital, the extent to which an extra dollar invested in resources today produces more than a dollar's worth of additional goods or services in the future. For example, if the government spends another dollar to increase the height of a hydroelectric dam, the dam should generate more than a dollar of additional electricity during its operational life. Third, there is the opportunity cost of capital, the rate of return from potential private savings accounts or investments that might otherwise use the capital spent on a government project. Part of the difficulty in evaluating opportunity cost of capital is the equity premium, the difference in the rate of return earned by a broad market index versus that earned by a relatively risk-free security. The purpose of governmental projects is to increase public well-being. Therefore, borrowing for projects should not significantly divert funds from private savings by consumers or lower the effective national rate of return on private business investments. Consumers tend to decide how much to save based on the rate of return for bonds, or business investors decide how much to invest based on the rate of return for stocks. Raising money for large public projects may displace capital from private savings, private investments, or some of both. If the public project displaces mostly private savings, then the appropriate discount rate is the bond rate of return, currently below 2.2% in the United States. At this discount rate, a consumer is equally likely to buy a U.S. savings bond or to put money in a savings account at a private bank. A higher rate favors the savings account. If the project displaces mostly private investment, then the discount rate should be the rate of return for stocks, which has averaged around 6% in the United States over the last 4 decades. Again, a higher discount rate favors private investment. In practice, discount rates tend to vary with attitudes about spending on public works and about government regulations. The British government sets a discount rate between 3.5% and 1% for government projects, depending on their duration. The U.S. Office of Management and Budget asks planners to prepare 2 cost-benefit analyses for proposed government regulations, one based on a discount rate of 3% and the other on a rate of 7%. Yields on U.S. Treasury bonds and notes were between 0 and 1.4% in 2011, and average yields on U.S. stocks were 5.5%. Discount rates of 3 and 7% thus exceed the rates of return for bonds and stocks, respectively, and discourage the enactment of new government regulations. The Office of Management and Budget does admit, however, that smaller discount rates might be appropriate for environmental projects with long time horizons.